Hello and welcome to Every Quarter. This is episode number 23 and the date is 31st January 2024. So in the last episode, we talked about fixed income investments and the risks that are associated with them. In this episode, we go further to talk about the different strategies that you can use to manage some of the risks that we identified in the last video. But first, some definitions. What is risk? In the last video, we defined risk as the possibility that your investment might lose value or underperform your expectations. That's what risk is. What therefore is risk management? Risk management is the continuous process of identifying, analyzing, and mitigating potential losses associated with your investments. And there are a number of such strategies that you can implement as an investor to manage risks associated with your fixed income portfolio. In this video, I go over 4 such risks, starting with number 1, duration management. So remember, in the last video, when talking about interest rate risk, we did mention that there is an inverse relationship between the value of your bond on the secondary market and the interest rate that is ruling at the time. So when interest rates rise, the value of your bond on the secondary market reduces. When the interest rates drop, the value of your bond on the secondary market increases. What this means is that the way to manage the risk, one of the ways to manage the risk of fluctuations in interest is to manage the bond tenure. So if you anticipate that the interest rates are going to rise in the future, it's better that you buy bonds with a shorter maturity period so that you can quickly, for those bonds, they can quickly come to maturity, and then they give you the opportunity to reinvest your capital in new bonds with higher interests. If you, on the other hand, anticipate that the interest rates will fall, it is a better strategy to invest very long-term bonds. And we're talking about, say, 15-year bonds or 10-year bonds, or even 5-year bonds, and not shorter bonds like the 2-year bonds and the 3-year bonds. What this does is that by doing so, you are locking in your capital into a bond that has very high interest rate for that long period of time. So remember, we're talking about fixed income investments. Once you've bought your bond at a specific interest rate, that's the rate that will, that's the return that you'll be getting every year for that period of time. So if you expect that in the next few years the rates will drop, you are better off investing in a very long-term bond now so that even when the rates drop the next 3 years, 4 years, you already have that bond locked in those very high interest rates. If you expect that within the next couple of years the interest rates will rise, um, it's better you invest in short-term bonds now, so that when the time comes for, when you anticipate the interest rates to rise, your bond will be coming to maturity and you have the opportunity to invest the money that you get your capital into a bond that has higher interest, coupon interests. So that's how you use the duration management strategy to manage your fixed income investment risks. The second strategy is laddering. So let's assume you had 600,000 kwacha cash, which you want to invest in a fixed income investment like bonds. You have two options. The first option is to get the entire 600,000 kwacha and invest it in a single bond auction. Basically, you get one bond with a face value of 600,000 kwacha, and let's assume it's a 5-year bond, meaning that from that 600,000 kwacha, you begin getting an interest coupon every 6 months for 5 years, and at the end of the 5 years you get your 600 kwacha back. That's one option. The other option that you have is to stagger that bond. You get your 600,000 kwacha, but you split it into 100,000 kwachas, as opposed to getting the entire 600,000 kwacha and investing it in one bond. You get 100 kwacha every month and invest in a single bond every month. So meaning that after 6 months you have 6 bonds. What that does is that it now provides you an opportunity to be getting coupons every single month for the next 5 years. So you buy bonds with staggered maturity periods, and this will help you with your cash flow. It will provide a very predictable cash flow, and it will give you an opportunity to be getting coupons every month, which you can then be using to invest in new bonds that are using new rates that are existing at the time. So this is called laddering, and it is one of the strategies that you can use to manage fixed income investment risks. The next one is our good old friend diversification. So you need to have a portfolio that is resilient, and the resilient portfolio is one that has different assets. And even within the same asset, you can have different asset classes, so to speak. By diversifying, you are spreading your investments across the different asset classes, industries, and geographic regions to reduce the overall risk of your portfolio. It's okay to start your investments with one class of assets, in this particular case, maybe bonds, but with time, you need to diversify. Some of the returns that you are getting from your bonds, let them go into other investments like stocks, into other investments like real estate, and a few other investments that are available to you. This is something that you need to do. You need to be deliberate about. Do not put all your eggs in one basket. That's very good advice for managing risk. The last strategy that I have is what is called rebalancing. So again, if you have a portfolio that is resilient, one that is diversified, it will have more than one type of investment. It will have more than one class of investment. It will be a portfolio that has bonds. It will be a portfolio that has stocks, and it will be a portfolio that has real estate, and a few other investments. And they will exist in different percentages. By that I mean they will be you have them as part of your entire portfolio, but allocated differently. So assuming that your portfolio has three different investments, you can have bonds that occupying 30% of your portfolio by value. You can have real estate occupying 30% of a portfolio by value, and maybe 40% stocks. So that would be your target asset allocation. And you arrive at your target asset allocation based on different things. I think much of it depends on your financial goals, and much of it depends on the kind of risks that you are dealing with, that you are vulnerable to. Much of it depends on your particular, peculiar financial situation in arriving at a target asset allocation. How much of your portfolio should go to bonds? How much of your portfolio should go to stocks? How much of your portfolio should go to cash? How much of your portfolio should go to real estate? That is something that you decide. From time to time, as the different assets, give you returns every month, every 6 months, every year, your asset allocation will begin to change. Maybe because you are getting so much from one particular asset and you're getting so little from the others. If you want to maintain the same target asset allocation, then you need to rebalance. It could be that you still want to maintain your old asset allocation because that's your strategy in terms of managing risk. So as the assets begin, the different portions of what makes your portfolio begin to rise or drop in percentage terms, you need to rebalance. This is a process of adjusting the weightings of the different asset classes within your portfolio to bring it back to its target asset allocation. That's what rebalancing is, and it's a strategy for managing risk when it comes to investment. That makes the fourth strategy, and like I mentioned, I had only four. The list is not meant to be exhaustive. There are many other strategies that you can employ. And that's why I want to hear from you. Are you using any of these strategies? Are there any other strategies that I've not mentioned that you are using? Drop your comment in the comments section. Let's get discussing. Let's learn from each other. From me, it's bye for now until yet again when we meet in the next episode when we talk about another exciting topic with regards to investing.